now we're seeing electric vehicle makers reach out to different commodity producers and do this kind of contractual long-term demand deals. That is so bullish for silver because it's just a matter of time before the Elon Musks of the world, or the executives at Ford or the executives at NEO and Rivian, they're going to start reaching out to commodity producers and saying, listen, we need a certain long-term supply. And that I think, that's where I think silver miners have, maybe 20, 30% downside, but they possibly have 600-700% upside.
We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Larry McDonald, New York Times bestselling author and the creator of the Bear Traps today. Thanks for joining me today, Larry.
Hi, thanks, Tom.
Great to have you join us from beautiful Panama there. It's looks a little bit warmer than where I am in Canada here, but I'd like to kind of start by having talking a little bit about some of the risks that you see today. You wrote the book, A Colossal Failure of Common Sense, the inside story of the collapse of the Lehman Brothers. So do you see some of those same types of risks today in this market environment?
Well, thanks for mentioning the book, Tom. It's now been published in 12 languages. And as a former Lehman trader, once a month, I tell my wife, I say, honey, if we sell 1 million books, we'll break even on our Lehman stock. But it's been a great book. It made the top 20 all time by the CFA Institute. And so it's a real gem of a book. It's still on Amazon, Colossal Failure of Common Sense. But today it's different in the sense that the banking system is healthy. A lot of the securitized lending products that brought down Lehman have been kind of cleansed. But under the hood, the leverage on the federal level or the sovereign level globally is pretty ugly. The leverage on the corporate level is pretty bad. So there's a lot more leverage, and this is so important for your viewers. So there's essentially an extra 30 trillion of debt that's below 2% today that wasn't around the last hiking cycle. So when the Fed's hiking rates, a 25 basis point rate hike actually carries the damage of maybe 75 basis points or 100. And so that's potentially very bullish for gold because in the old days, the Fed could go through a long hiking cycle, very boring, and you would have what's called a high terminal rate, and that's the terminal rates, to keep it simple, that's the rate where the Fed stops hiking. So going back 30, 40, 80 years, there's a point where the Fed hikes and stops. In every cycle, that's been getting lower and lower, and the leverage in the system is causing that, because if they hike rates too much, federal tax receipts, I mean, when you have 30 trillion of debt, 1% increase is a meaningful, $300 billion of excess interest payments, right? For every 1% on 30 trillion of debt. Mm-hmm. So you're talking about a dynamic where this cycle, what's really bullish for gold and silver is when the Fed goes into a hiking cycle, that creates financial condition tightness. And that's what was happening during Lehman. So in Lehman, the Fed was hiking rates over a long period of time, 2004 to 2007 or so. And the mortgage resets created this housing crash. Mm-hmm. Here, the Fed's trying to kick off a hiking cycle, but there's so much leverage in the system and there's so much inflation that's already hiking rates that they probably have to, they're not going to be able to hike rates for a long period of time. And that's very bullish for gold and silver.
Mm-hmm. Right in that vein, Larry, that, you're talking about the start of the hiking cycle. Is there any historical precedent for inflation of 6.8% or even higher to be actually reined in by a Fed funds rate of 1.5?
Well, that's the thing. They're so far behind the curve. So Poland did their fifth rate hike before the Fed has even done one 25 basis point hike. Brazil has hiked rates 800 basis points before the Fed has hiked one time. Russia, South Korea, Mexico, the whole world has been hiking rates while the Fed this cycle has been waiting. And what happened was we get hit by these Delta variants are like the biggest head fake because, if just look at oil, the Delta variant knocked oil down in the third quarter last year, and then oil rallied. And then we had the Omicron, 20, 30% drawdown in oil, and now we're at new highs. Mm-hmm. So what's been happening is the Fed was going through a regime where they wanted to withdraw a combination over the last 12 months. They get hit by these COVID variants. They deer in the headlights. And so they didn't hike. And now we have oil that is a runaway freight train. The markets smelled this out. They smelled out I want to say the BS in COVID variants. COVID variants are real. They're just not as deadly as the first variant. And the amount of human beings on the planet Earth that have been vaccinated relative to the amount of people that had COVID, each one of these variants is less dangerous. But the Fed hasn't hiked rates. And globally, we've already had, I think we've had 60 rate hikes globally. And so the Fed is going to have to try to catch up here. And if they try to catch up aggressively, they're just going to put us in a recession that's really bullish for gold and silver. Mm-hmm.
So, Larry, we've heard previously that the bond market is, one of the smartest markets, and we should really pay attention to it. Considering the dynamic that the rest of the world is hiking and the U.S. is still kind of, I've had recent guests say that the Fed is so far behind the curve they can't even see it. Does that, make that market in a way not as instructive as it typically is?
Yeah, this time around, the high yield market did not pick up as well as it has in the past on this latest drawdown in equities. Now, the economy isn't crashing at the same speed as it was, 2018 in the fourth quarter. We were really crashing on the economy while the Fed was same thing. They were threatening rate hikes and balance sheet. So they're basically trying to do two things at the same time: reduce the balance sheet at $50 billion a month, and they were threatening multiple hikes for 2019. And the beast in the market stopped them in their tracks. They had to reverse. They ended up cutting rates 2 or 3 times in 2019 after promising us like all these hikes. And gold miners did very, really well. So gold miners do incredibly well when the Fed has to back away from a promised hawkish path. Mm-hmm. Credit markets are starting now to really not seize up, but credit's weakening at a very fast speed globally, especially in Europe. So inflation is inflicting pain on corporations, on supply chains. Margin pressure is just, C.H. Robinson, which is a company that we follow, it's a bellwether, but C.H., their whole business model has been able to take in the last 20, 30 years, has been able to take advantage of supply chains. And now labor costs are hitting so many companies like these guys so credit markets on the corporate level, because of the refinancing of debt over the last 18 months, these companies have been able to push out maturities. And that's taken a little bit of that stress away. So in other words, there's been so many bonds issued. The corporations in America, especially, were very wise to basically issue bonds and then take the near-term maturities and push them out. So they've just pushed the credit risk out in the future. But if you look at 5s, 30s, and the level, so that's treasuries, the 5-year treasury versus the 30, that spread in terms of where it's trading is at the point where the Fed actually started to cut rates and reverse last time. So 5s, 30s are telling you, in other words, what's happening is the Fed's threatening to hike. So 5 years and 2 years yields are going up, but 30 years are not moving up anywhere near as fast because the 30-year bond's really looking at future recession. So the curve is almost, in another couple of months, we could be inverted. And that's a real sign that the Fed is triggered a recession. Mm-hmm. So 5s, 30s are telling you that the Fed's behind the curve, that we're close to recession. Also, another thing that we look at, this is extremely important, the XLP versus the XLY, so your consumer staples versus your discretionary stocks, they are outperforming discretionary stocks by close to 20% since November. So your Walmarts, your Johnson & Johnsons, your recession-proof companies, these companies are companies that Costco, companies that do well during recessions, they are dramatically outperforming. And so if you look back over the last 60 years, when the XLP or when the staples per se are outperforming discretionary stocks, that's a real reliable recession indicator, especially if you line that up with 5s, 30s, and treasuries. So you have two pretty good indicators that are pointing toward a near-term recession. Once again, that prevents a long hiking cycle. Once again, that's really good for your silver miners, your SIL, your GDX. Where the miners get crushed is a long, boring hiking cycle where the Fed is actually driving real rates higher, and that's what we experienced in the last cycle, where it's 2013. They started the taper. They promised all kinds of hikes. The dollar strengthened, and gold and silver got killed. And then in 2016, right ahead of the election, the Fed had to back away from that hawkish path. And in the first 2 quarters of 2016, on that back off, the gold miners were up about 140%.
Mm-hmm. Larry, you explained to us how oil got affected by some of these Omicron variants, and you recently wrote that the dollar desperately needs another COVID variant to come and save the day for it. So how do these variants affect the dollar as well? And is it kind of a safety trade for everybody to just be buying dollars when we see another one of these variants come to the forefront?
That's it. So the planet Earth, 64 trillion of GDP outside the United States, 64, 20 trillion in. 64 outside the United States of GDP, 20 trillion inside. Now, when I was growing up in the business now in the late 80s, it was almost like 50. The US was probably like almost 50% of global GDP. Now it's 64 outside, 64 trillion outside, 20 trillion in. And so when the dollar's a totally new wrecking ball, because as we saw in 2013, 14, 15, Janet Yellen dramatically underestimated the impact on the dollar. And so they promised all kinds of rate hikes. The dollar ripped, and it obliterated the global economy in 2015 to the point where China had to devalue their currency. And then 2018, same thing. We obliterated the global economy twice there. And both times the Fed had to back away. So what happens is when you come out of COVID and there's less threats and people are taking COVID less serious, what happens is those demand for foreign currencies, your Korean won, your Brazilian real, in a world with just like without a global threat, without a Brexit, without a trade war, without a COVID, dollars are just going to scream out of the United States. And I think that's a really good setup for hard assets for the second half of the year, because it's the boy that cried wolf. The media has embarrassed themselves by, without Trump, the media complex needs these types of things like variants. They need shock, to capture eyeballs, whether it be CNN or whatever. That's the way that the media, the way newspapers have always sold newspapers, right? So it goes back to for literally 100 years. It's the way things work. So if COVID's not as much a threat over the next 12 months, then the amount of dollars that will start to move out of the United States into hard assets, and with a weaker dollar, is extremely strong. So the last 10 years, we've had, like I said, Brexits, trade wars, COVIDs, and then all these COVID variants. So it's like, it's been this literal incredible tailwind for the dollar, incredible tailwind for tech stocks and growth stocks, incredible tailwind for bonds. Now we're coming, Brexit's gone, trade wars are gone, COVID and all the variants gone, drives assets internationally, weakens the dollar structurally, and then it's that whole thing creates a massive rotation out of growth stocks into value stocks and into hard assets like your tech resources, your mosaics, companies that produce either things like copper, phosphates, hard assets, oil, silver mine. We love Hecla. We absolutely love Hecla because the industrial components now, this cycle, Hecla Mining is a silver producer, and you've got your electric vehicles and your solar engine over the next 10 years. So hard assets, looking over the next decade over financial assets, which are growth stocks and bonds. You want to be in hard assets for the next 5 years.
You know, we touched on earlier that your outlook for both gold and the miners is very bullish either way, if the Fed gets aggressive or if it softens their proposed rate hike path. So can you explain to us, you know, why you're so bullish on gold in both of those cases again, please?
Well, what would hurt the miners would be like another COVID variant let's just say it was a repeat of one where it was a COVID variant that was actually deadly, right? Whereas Omicron is almost like a flu-like element. So where gold would do pretty poorly is in that environment that would strengthen the dollar, and we would go back to capital would flow back in the United States. Growth stocks would your Netflixes of the world, all those types of companies would really benefit. But what's happened over the last 18 months is each COVID variant it's been the boy that cried has carrying less, like it's having less of an effect on the rotation. In other words, each COVID variant brought a lot of money back into bonds and into growth stocks, but each COVID variant's having less and less effect. So as we look out over the next 2 years, we know that backdrop has been developing. So that threat to gold and to hard assets is much weaker than it was a year ago. And so that's number one. Number two, where gold and silver do poorly is where the Fed can hike rates 25 basis very softly, 25, like between 2004, 2008, as I talk about in my book, A Colossal Failure of Common Sense, the inside story of the collapse of Lehman Brothers, they did 17, 25 basis point rate hikes from like 2003, 4 to 2007. It's a long, boring hiking cycle. Gold and silver did very poorly. If they're forced to be aggressive, then that basically brings forward recession risk faster. And recession risk is what really helps gold and silver because that real yields, your yield after inflation is lower in that environment. Whereas if the Fed's going on a long hiking cycle, real yields are higher and they can push, the Treasury can push yields much higher and gold's not as attractive. Whereas if you have inflation and in a recession, that's the best possible world for gold and silver.
So you mentioned silver there, Larry. Why do you see silver as being wildly mispriced at this point?
Well, first of all, when you come to a point where the Fed's threatening accommodation, silver miners underperform gold miners, and gold miners underperform gold, right? So your tertiary, I hate to say the word tertiary, but it's your fringe, like your higher risk elements do much poorly when the Fed's threatening to pull back accommodation aggressively. And that's what's been happening. So your silver miners are underperforming your gold miners, and your gold miners have been underperforming gold over like the last 18 months, the last 12 months as the Fed has gone from, 12 months ago, the Fed was basically threatening very little, and now they're threatening very lot. So you've had this dynamic. What happens is when the Fed pivots or just it just slightly shifts from extremely hawkish to, like in 2016, 2015, 16, they were threatening 8 rate hikes. 8. They did 2. 2015, 16, they promised the world. I was at SocGen. I was in meetings. These economists are just, clueless economists that have never sat in a risk-taking seat. So they don't understand risk management. They don't understand risk assets. A lot of economists will get on TV and say, oh, the Fed can hike rates 8 times. The whole thing is just complete idiocy. And at the end of the day, every economist on Wall Street was saying 8 rate hikes for 2015, 16, because of financial conditions, because of the wrecking ball that is the US dollar, they only got away with 2. Now, in that environment, when they shift any kind of back away, that's where silver outperforms out of the gate. So it underperforms as the Fed's threatening. As the Fed softens, silver miners will outperform gold dramatically. And that's what happened just about in every single cycle. But this time around, as it's pretty obvious now. I think everybody knows the industrial component, the weight of an electric vehicle has just, is just far more silver and copper components than in previous decades where automobiles just didn't have much of a silver component. So your silver there, and with obviously with solar panels, you just have a whole different 20-year outlook on silver industrial demand. So for the last 20 years backward looking, silver's been this macro metal that gets whipped around by central bankers, either promising rate hikes or taking away those promises. Mm-hmm. That's been your silver play. Whereas here now, your downside is, I think, much smaller with the silver miners, because you can look out 10 years and say, and look at Elon Musk. To me, this is one of the most bullish things for silver. Elon Musk is reaching out to magnesium producers of different commodities and saying, I want a 10-year supply. In other words, it's just like with uranium. See, there's certain commodities out there where the national security or the security for the company or the industry is very high, like uranium plants. Nuclear power plants cannot run out of uranium. It's literally, so in the uranium space, they have to contract out for long periods of time. And that basically gives the industry a kind of a bedrock of demand. That has never been the case for silver or copper. But now we're seeing electric vehicle makers reach out to different commodity producers and do this kind of contractual long-term demand deals where they're actually saying over there. That is so bullish for silver, because it's just a matter of time before the Elon Musks of the world, or the executives at Ford or the executives at NEO and Rivian, they're going to start reaching out to commodity producers and saying, listen, we need a certain long-term supply. And that I think, that's where I think the silver miners have, maybe 20, 30% downside, but they possibly have 600-700% upside.
That's a really interesting way to look at that, Larry. So do you think that puts a new floor under the price of silver, but also acts as, in some ways as a ballast to prevent it from really spiking the way we have seen it in the past at times? Yeah,
you hate to use the word floor, but there is some level of foundational demand that should be there. Like I said, if we have some wacky thing where a COVID variant hits us and it's, incredibly dangerous, and we go back to severe lockdowns, and there's a flight to quality into the dollar, that is not going to be good for, precious metals or value stocks. Mm-hmm. It is potentially recession, so once again, that you bring in that recession risk. But at the end of the day, it'll strengthen dollars so much that, because the rest of the world's a balance, right? If the rest of the world, that's 64 trillion of GDP outside of the United States, if that's being hammered by COVID, money just comes into the United States. Whereas 64 trillion of GDP outside of the United States, 20 trillion in, if COVID is dissipating, that naturally gives a bid to global currencies that takes away demand for the dollar. And that is your best dynamic. So I don't want to say a floor, but I do say relative to past cycles, there's a bedrock of demand that wasn't there before.
Interesting. So do you see a lot of the same fundamentals at play for platinum as well?
Absolutely, because now the tricky part of platinum is it's just such an incredible debate, because we run a Bloomberg chat with about 650 institutional investors in 22 countries. So we have these debates in the chat. So it's on Bloomberg, your hedge funds, your mutual funds, your pension funds. And the debate in there around there's two elements to PGM, right? So your palladium and your platinum. And so you have a demand for catalytic converters as automobiles need to cleanse emissions. And that's always been there. But that's dissipating over time because your electric vehicle demand is increasing. So that's a negative. But then as you move toward green hydrogen, larger vehicles, that element, that hydrogen element where the heat, the resistance, I mean, platinum's resistance to high heat levels is the best of just about any metal in the world. And platinum's, 100 times more rare than gold and silver. So you just don't have a lot of it. It's only made roughly in a couple of countries, South Africa and Russia. And that's, I think, controlled like 70% of the production. So your demand for platinum is, I love platinum here because you have that green demand, but it's a relatively precious metal in terms of it's hard to find, it's a hard asset. You have a dynamic where the automakers over the last 18 months have been hurt by supply chains and chip shortages. And so that your catalytic converter demand is going to basically increase over time. You're going to have a long-term demand cycle from hydrogen, and there's just not a lot of platinum out there. And there's been not a lot of CapEx in the mining space relative to previous decades. That's the one thing that we talk about in the chat with institutional investors, and we have these debates in the chat. And most of our clients are on the institutional side. We do a recap of the chat for the retail audience, and we'd be happy to share that with some of your viewers. But that's the big debate, is the long-term hydrogen cycle, green hydrogen cycle demand for platinum versus your catalytic converters and traditional auto production.
So Larry, is there a particular way that you go about trying to, evaluate gold miners to be investing in? Or are you more of a short-term trader and favor names with higher liquidity, or do you want to be in some of these names for a longer time frame?
Well, in the chat, we have contributors that are partners that work with the Bear Traps report, and a couple of them are very seasoned managers in the gold mining space. So, we look at balance sheets with them, but I really respect the eye of a portfolio manager that's been poring over these balance sheets for a long time. These balance sheets in the mining space relative to the gold mining space and the silver mining space relative to the last cycle are so much cleaner, so much less leverage. And, that gives you a lot of downside protection relative to the last cycle, 2013, 14, 15, the Fed hit the gold mining space and the silver mining space over the head with this kind of aggressive, Fed was the only central bank in the world really aggressively hiking rates. Now the Fed's last. So the balance sheets, those companies were not well positioned for that. Mm-hmm. And it's just like any cyclical thing where CFOs and treasurers were decimated by the last cycle. And so now they have a lot more bandwidth to take on risk. They just don't have as much leverage. Mm-hmm. So, but overall, the cleanest balance sheets, your Barrick Gold, your GOLD equity, your Newmonts, your Heclas, your Agnico Eagles. I mean, those are the four core ones that we focus on. And then we'll use the GDX or the SIL to just own a basket of them as well. So we like to own, and what we'll do is we have trade alerts that go out via WhatsApp. In the last year, we've been selling the rallies. We've done a great job this cycle selling the rally. Last cycle, we didn't do as good a job, but we've sold gold and silver miners. What we'll do is we'll take a base position in the trade alerts that go out to the clients. We've been selling, 1/3, 2/3 of these positions over the last year, buying as we, get back down here to capitulation levels. Since September, we've had some pretty good capitulation levels in the miners. And so we've been selling the rallies, buying the dips, but we want to be there for the turn. And so we have a long-term, 3 to 5 year bullish view. But what we'll do is we'll buy into capitulation during this latest sell-off, sell the rallies, hold the base position for the 2 to 3 year outlook, but be there for the turn and not get stuck with, an entire pad of gold and silver miners while the Fed's pulling back the combination. That can be a very miserable experience.
Right. So I'd like to talk a little bit about how you kind of see buying and entrance positions. So you wrote in one of the recent Bear Trap reports that buying right never feels good, but the weekly RSI is at one of its most attractive readings in the last decade. So talk to us a little bit about the psychology of buying right like this, and if you think about seeing that discomfort as an indication of finding a great trade.
Absolutely. So that's where I learned how to trade. When in the 90s, I was chasing rallies like just about everybody, buying breakouts. And that's what everybody does. Every technical analyst on Twitter just about does the same thing. They're all doing that. They're basically all buying breakouts. They're waiting for a capitulation process to end. They're getting in safe. The problem is a lot of times those things you'll have reversals, and that type of experience can be pretty miserable. And so what I like to do is, and what we've done with the Bear Trap support over the last decade, is we will, and Seth Klarman says this, buying right never feels good. And that's his famous line. And so what we do is we have a 7-factor model that measures capitulation. We want to buy into the capitulation process, mathematically measure it. Like if you think about a stock, if a stock goes from 80 to 100, say it's a $100 stock or an $80 stock, all of a sudden it makes a capitulation low in the 40s, and it trades aggressively down there in the 40s or 50s for a 6-9 month period of time. And then two to three things happen in the course of a year, whether it be, take the oil industry, for example. The oil industry in 2020 was hit with COVID, and then a Democratic debate process where we had, I think, 8 or 9 plus debates where every candidate was saying, if I take the White House, we're going to be almost, outlaw fracking, right? So all the risk, all of the investment capital, all of the kind of investment in what we call CapEx came out of the energy space. The space by the fourth quarter of 2020 was decimated, and the capitulation was that where we were measuring this with our model was so intense because you had a category 5 capitulation in the second quarter of 2018, a counter trend rally in the middle of 2020. So you're talking about first quarter 2020, horrific capitulation in energy that was triggered by COVID. Counter trend rally into June of 2020. And then by the election, it was a horrific, and remember, the vaccines hadn't come out yet. It was the vaccine timeline was kind of mysterious out in the future. So in that fourth quarter, and then you had tax law selling. So it was really a triple barrel capitulation, and the model quantifies that. And then what you do is you figure out, okay, there's a whole new ownership of energy stocks at a whole new different price. And so what we want to do is buy into the capitulation process, lighten up into the rallies, but be there for the turn, and then, buy and hold it for a number of years. But we will lighten into the process. And it looks like we're aggressively trading. We're in the position for 2 years, 3 years, but we will sell those rallies, measure the capitulation when we feel peak seller exhaustion, which is that, as I think we are now with the gold and silver miners. Mm-hmm. Then we want to be there for the turn and sell less and really hold a nice core position for the long haul.
Conversely, Larry, when we think about taking some of those profits off the table, that's equally as or even more difficult. So do you have any framework about how you think about taking profits as well?
Well, that's the key, because like 50% of gold investors are what we call gold bugs, right? And they're just waiting for, and I have a lot of these kinds of, it's almost like therapy, right? I mean, I'm working with these, like, you can't be a gold bug because you just can't sit there and hold an asset waiting for an exogenous event. It's not a good idea. Mm-hmm. And so that's one of the advantages of really taking advantage of capitulation is not so much buying and holding and sitting there with, I talk to people, sometimes I hear people with 30, 40, 50% of their net worth in metals, and, for long periods of time. That's just not a wise investment strategy. So, and it's not just precious metals. Like in the early part of the cycle, you want to be in oil, you want to be in copper, you want to be in aluminum. And so the early part of a commodity cycle, those are going to kick ass much more so than gold and silver. So in your growth part of the commodity cycle, and now as you come in toward the late part of the cycle, as you get closer to the recession, that's where what we're recommending is we've had dramatic positions in energy and copper, and we've cut those positions in half, and we've doubled up on gold and silver. And so I think that's the way to look at it, is you want to treat commodities like almost like a baseball team or a football team. You've got different players that do at different positions, and they're going to have strengths and weaknesses at different parts of the cycle. Mm-hmm. Early part of the cycle, as you come out of a COVID dynamic, oil, copper, incredible returns. But as you get later, I suspect this year, and we're measuring, for example, every day, every week, we're measuring the GDX versus, say, the XME. That's going to be a great indicator. So we're looking at the XME as a basket of more industrial metals. And, when that GDX starts to make its move against the XME, then we know we're coming out into the valley where the GDX is going to probably go on a solid run.
Mm-hmm. Yeah, and interestingly, as you mentioned aluminum there, we saw today that aluminum hit an all-time high, I believe, right?
Exactly. So aluminum is crushing, like Alcoa versus Newmont. I mean, just pull up look at Alcoa versus. I mean, it's like you could measure it going back like 100 years, and there's rarely been a period where Alcoa outperformed Newmont or Agnico or Barrick by this percentage, and that's classic early, mid-stage cycle. Mm-hmm. And so, but as the Fed starts to threaten rate hikes, and as the inflation sword comes closer, that's where your Alcoas of the world will start to suffer, and the gold miners will start to really outperform.
Interesting. So, Larry, another piece of that you mentioned was oil as well. And in a recent one of your guys' reports, you wrote that any significant impacts on the demand side could trigger a 2008-like super spike in oil. There is little room for error. So is this because inventories are so low? Is that, why is that there is such little room for error at this point?
Well, the Davos crowd and there's a political element to the world, and they mean well. I mean, these people really mean well. So they're focused on supply, and they're focused on ESG, and they're focused on putting constraints on companies and lands and all these relatively Pollyannish, idiotic things, right? Because they mean well, but at the end of the day, we have 1 billion people in India that have no access to electricity. We have 200 million, maybe 150 million in India, 250 million people in India that have no electricity at all. And I'm sorry, it's 1 billion that have no access to air conditioning. So 1 billion human beings in India have no access to air conditioning, and about 150, 200 million have no access to electricity, period. And what's happened is we've gone through a global dynamic where we've taken a lot of jobs out of the United States over the last 20 years. We've shotgunned them around the world. Middle-class people in countries like India, the middle class is expanding. And when you go from making, like $100 to $300 a year to $2,000 to $3,000 a year, you're going to start consuming more energy. And so you have millions of people moving from, extreme poverty into lower middle class, and, millions of people moving from lower class to middle, upwards of middle class in emerging markets. And like I said, you get 1 billion people that have no access to air conditioning. I mean, this is absolute madness. So the slightest move up in the middle class in these countries is going to impact massive amounts of demand for oil and electricity and gas. And so the whole global complex is massively miscalculated here. So they've spent like 10 years working on a Green New Deal and green recovery and the whole thing, but they're not. And there's 1 billion people in China without an automobile. 1 billion. So there's like 350 million automobiles in China, and there's 1.4 billion people. So there's 1 billion people without an automobile. Once again, the middle class in China is expanding. So over the next 20 years, and over the short term, as we come out of COVID, the next 20 years, you can see an incredibly bullish dynamic for oil and gas. But your question was around, okay, short term. So over the last 18 months to 24 months, we've gone through this ESG renaissance that has crushed. And then we had COVID. Both of those dynamics have crushed the investment in the energy space. And everybody knows this now. Like a year ago, this was our thesis for being long energy. Everybody knows now that we are massively underinvested. And it's like turning around an aircraft carrier. You just don't like flip on CapEx and get energy out of the ground or oil and gas. I mean, it's going to take a long time. So if you whip out of COVID and these emerging market countries are now growing at a fairly fast clip, we're going to be massively under supplied. And then if you have any kind of geopolitical element to it, that's where you get, I lived through that in 2008. I mean, think about it. In 2008, the US went into recession in November. I wrote about this in my book. So we didn't know it at the time, but in November of 2007, the US went into recession. I'm going to repeat that. In November of 2007, we entered recession in the United States. In the first 2 quarters of 2008, oil went from $90 to $140, and to the point where the Nigerian rebels, which the oil global supply was so tight that Nigeria had these. Every time they basically started to, there was a group of people in Africa that were attacking the pipelines, and the market was so tight that just that little amount of supply from this region would dramatically increase. If there was a cutback in the supply from that region, oil would spike, and that's how we got up to $140 by the second quarter of 2008 during a recession. I mean, it's mind-boggling that oil exploded during a recession, but that's what a geopolitical / tight market can do. And here we are. We've done it again. The entire setup is positioned very much the same way. So we could easily have a super spike in oil, which creates a huge move in upward move in inflation that forces the Fed into extreme action. And then we just bring forward recession risk very fast. Gold and silver do really well through that environment.
Yeah, I think you point out a great indication of how bullish some of these companies think their actions are so bullish. You pointed out that Pioneer just spent $328 million to lift all of its hedges. So this is, obviously very bullish action that we can kind of look to where the smart money is placing their bets, right?
Yes. So we were on calls with clients so we have both institutional clients on the buy side, so hedge funds, mutual funds, and we get on calls with the CFOs and treasurers. And we were on calls like a year ago, and the companies were extremely hedged because the psychology was, imagine you're the CFO of Pioneer or any energy company. You go through the Brexit, you go through the trade war, and then COVID hits. And oil demand gets decimated. And all the investments that you made those previous 3-5 years have blown up. And your boss just got fired, his boss just got fired. you're the new CFO or treasurer at the energy company. And when the subject of capital investment comes up, you literally get out of your chair and run out of the room. This is what happens. This is the psychology of markets. It's long. This is why supply and demand dynamics, take place and these dislocations. Now, finally, after a nice bull market run in energy, for the first time in a year and a half, 18 months, 2 years, we're starting to see CFOs and treasurers roll the dice, take some of that cash. They're sitting on billions of dollars of cash. They're paying enormous dividends, and they're starting to roll the dice. That's extremely bullish for the Schlumbergers of the world, your servicers, because the OIH and your servicing companies have dramatically underperformed as oil companies have gone through a capital retention renaissance overdose. So because of that fear and all those dynamics I just laid out, it's been 18 months, 2 years of just colossal overdose of capital retention, paying out dividends, buying back stock, not moving into exploration. And now we look at all the companies on a monthly, weekly basis. We're starting to see some of that CapEx come back. That's what makes us extremely bullish on your Schlumbergers and your servicing companies, because they will outperform in that kind of cycle. They've dramatically underperformed during this last 18 months as companies have been retaining capital and returning capital to shareholders.
Mm-hmm. Yeah, the picks and shovels in a way of the energy industry, right?
Yeah, it's exploration. So the technologies that Schlumberger has around exploration in terms of like identifying where the hotspots are for oil is just incredible. It's a high-tech company. It's at the most advanced oil fossil fuel detection equipment in the world. Plus, these companies in the OIH also service wells. So the more wells that we actually have, the more servicing revenue they have. Whereas right now we're hundreds of wells short of where we were in 2019 in the United States. Globally, it's a big number. Mm-hmm. So the servicing companies have really suffered.
Larry, I want to thank you for a really interesting conversation here. But before we wrap up, I'd like to talk a little bit about, you obviously watch a lot of relationships in the markets. And one interesting relationship that I saw that you pointed out was the relationship of the VIX and Bitcoin. So could you tell us a little bit about that relationship and what it shows us?
Well, listen, the Bitcoin loyalists mean well, right? Michael Saylor, these guys, and they mean well. They're looking at the deficit. They're looking at unfunded liabilities in the United States, close to $200 trillion, right? They're looking at 30 trillion of debt. They're looking at a government out of control, reckless spending. They mean well. At the end of the day, the bottom line is for the last 5 years, whenever financial conditions have tightened, things like crypto have been over and over and over again, dramatically just taken out to the woodshed. And if you do the math, the reality on the ground is, although you can make the case that the long-term store of value case for Bitcoin and crypto is very strong, but unfortunately in this early stage, immature part of where cryptocurrencies are, we're still at the infantile stage. They are essentially a short vehicle. So if you're long crypto, you're actually short the VIX. Mm-hmm. It's a mathematical fact. Okay, we have all the data. If the VIX moves at a certain speed up in an elevated fashion relative to financial conditions, which are tightening when the Fed is pulling back accommodation, you will get destroyed in crypto over and over again, whether it be 2017, 18. So we just had more and more dynamics where the VIX exploded during COVID, right? Exploded during COVID in the first, second quarter of 2020. And once again, crypto annihilated much more than the NASDAQ. So over the long term, the intellectual case for cryptocurrencies will be very strong. Mm-hmm. But unfortunately, when you're long crypto in 2021, 22, 23, 2018, 19, 20, in this period, you are short volatility, you are short the VIX.
Interesting. Larry, thank you so much for sharing all of your perspective and knowledge with us today. Of course, your website is the beartrapsreport.com, and you're available on Twitter as well @ConvertBond. Anywhere else you'd like to point to?
No, just it's really great to be with you. And as a former trader, I really enjoy getting out on the road. We've done about 140 speeches in 16 countries, and the Bear Traps Report has an institutional component and a retail component. And we're happy to work with people, and they can just reach out to us.
Excellent, Larry. Thanks so much for your time today.
Okay, I'll see you at the top. Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.